Hey, happy weekend. It's Saturday, June 18th, and this is Mark Hines with your 4-minute weekend review of the markets. As always, I've got 4 points for you this week. We're going to talk about what happened in the market. We're going to talk a little bit about a couple interesting investment ideas. It's going to be a mortgage REIT AGNC Investment Corp and one of PIMCO's sort of highly levered, high income bond closed end funds. That's the second thing we're going to talk about. Next thing we're going to talk about is the week ahead and what investors can expect. And then finally, what should you be doing in your investment portfolio in this market? So the theme for this week is interest rate carnage. And that sounds really bad. And if you look at the market on a short-term basis, things have been really bad. The S&P 500 just finished its worst week since 2020. It was down about 5.8% on the week. And the reason for that is the Federal Reserve raised its target federal funds rate 75 basis points. That is the largest interest rate hike by the Fed since 1994, when Alan Greenspan was the chairman of the Federal Reserve. And of course, you know that the reason they hiked interest rates is they are trying to battle inflation. So the CPI number, for example, has come in over 8% year over year for a few months in a row. What that means is everything costs more than it did a year ago, right? If you want to go out and buy something, it costs 8+% more than it did a year ago. And that's got the Federal Reserve really, really scared. That can really hurt the economy and put it in a bad situation over the long run. So the Fed is now aggressively hiking interest rates in an attempt to slow inflation. And of course, the other side of that is that as they hike interest rates, it slows the economy and it could drive us into an ugly recession. Just to give you a little perspective, the stock market overall, the S&P 500 is now down around 23.4% for the year. The tech-heavy NASDAQ is now down 31.8% for the year. And then just for reference, the ARK Innovation ETF, that popular growth stock ETF that was absolutely soaring during the sort of pandemic bubble, I guess we'll call it, that one is now down 60% year to date. So it's been rough out there. And really the theme is just that interest rate carnage. And talking about interest rate carnage, the two investment ideas I want to talk about this week, the second point on my list is related to interest rates. Specifically, they are high yield investments. The first one is AGNC Investment Corp. This is a highly levered mortgage REIT that pays a double-digit yield. And then the second one is the PIMCO, one of PIMCO's bond, the closed-end funds, also uses leverage and pays a double-digit kind of distribution yield. So they both got absolutely slaughtered over the last week. They've been going down this year. Might as well start with that PIMCO bond fund. PDI is the ticker symbol. Basically what's going on there, they invest in bonds, fixed income instruments, some of them high yielding instruments. And so the first thing going on there is as interest rates rise, bond prices fall. So it's been unique this year. This has been one of the worst years for bonds, and that popular PDI bond closed-end fund from PIMCO has been down a lot. Excuse me. And then as the Fed hiked interest rates this week, it really tanked. It cratered very, very hard. There's some talk about risks related to that fund. There's a 50% leverage limit, regulatory leverage limit, which they are bumping up against, just sort of mathematically as interest rates rise, bond prices fall, and that'll increase the sort of leverage ratio on that fund. So things are looking pretty dire, but sometimes contrarians like that. And from a good news perspective on PDI, they do have a lot of shorter maturity sort of holdings in there that they can use for liquidity purposes. So they're not necessarily forced to sell some of their longer dated things that would be down even more. So PDI is pretty interesting. The other one, AGNC Investment Corp. This is a mortgage REIT. AGNC, the actual holdings of AGNC are mostly government agency-backed securities, which are, on a standalone basis, excuse me, a lot less risky than some of the things that PDI holds. But the deal with the AGNC is that they use a lot more leverage. So AGNC was down enormously as well this past week as the Fed hiked interest rates. The yields have soared. The issue kind of there with AGNC is that, they could have some deterioration to their book value. So just a point I want to kind of make on these two high yield, highly levered, big dividend type investments is that, they take big hits as they go through the market cycle, right? You see people come in and own them for a few years and they're like, oh, these are great investments. But when things get choppy like they are right now, they can take some pretty big hits. I think they may have lost a little bit of book value, as we'll see at their next quarterly earnings release. But going forward, the higher interest rates are actually better for both of those funds on a go-forward basis. So if you're a contrarian, they're worth taking a closer look at. And again, those opportunities were created by sort of the interest rate carnage in the market. So the third point I want to talk to you about is the week ahead. What can we expect in the week ahead? More volatility. Pretty good chance that we're going to see more volatility in the market. People have been trying to call the bottom in the market for a while now. If the Fed is, arguably sort of more set in their sort of trajectory for interest rate hikes, that could be good for the market. Again, we're going to have to wait till we see more sort of economic data come out with regards to the rate of inflation. Again, sort of the trick for the Fed, or the difficulty for the Fed is, one, that interest rate data they get is a little bit lagged. And then two, when they raise and hike interest rates, the impacts of those hikes are also lagged. So it's really sort of a blunt tool that they're trying to use right now to finely tune the economy. On one hand, they want to slow inflation. The other hand, it seems pretty risky that they're going to drive us into an ugly recession. So things are ugly out there. The other thing we're going to see in this upcoming week, we've got a couple earnings announcements on Thursday, one from Accenture. This is sort of a IT technology consulting company that I like. I own some shares. They're a good sort of leading indicator of what's going on in the tech sector. So that'll be an interesting one to see on Thursday. And then FedEx is another one. They're going to announce earnings on Thursday of this week. I'll be particularly interested to hear what they have to say about sort of e-commerce and some of the industrial properties that they work with. Things are starting to slow in that regard. Stag Industrial is another sort of industrial sector REIT that's down a lot. Amazon came out and said, oh, we're going to use less industrial real estate property. So the whole industrial REIT sector is down. That's another interesting one that I follow. So in the week ahead, pretty sure we're going to see more volatility, more people try and call the bottom, more, fear mongers saying we've got, a ton more room to fall still. The reality is nobody knows in the short term what's going to happen to the markets. So then the fourth point here is just what should you be doing in your own investment portfolio? Disciplined, long-term, goal-focused investing has been a winning strategy over and over again throughout history. I think it will be again this time too. As an investor, you should have long-term goals. And then you should set up your investment portfolio accordingly, right? If you are sort of a lower volatility income focused investor, don't go dumping your entire nest egg into, super high growth ARK innovation ETF type stocks right now, just because you think we've hit the bottom and we're going to rebound. No, don't do that. Stick to your goals. Similarly, if you are a long-term investor and your portfolio is down and you own a lot of growth stocks, I wouldn't necessarily go dumping them now that the market has fallen. Just stick to that long-term strategy, that long-term goal. As they say, this too shall pass. I remain optimistic about the market in the long term. I think that once interest rates settle down from the Fed, once we get some indication that inflation is calming down, which I think it will, I think the market's going higher from here. So again, disciplined, goal-focused, long-term investing. That's it for me this week. Thank you very much, and I will see you next week.